Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get to the headlines. The Indian markets break a three-day gaining streak. Nifty trades below the 10,800 mark, dragged down by IT stocks.
Inflation jumps to a 14-month high in May. Fuel costs post the sharpest rise.
India's current account deficit widens in the fourth quarter compared to a year ago, lower than what it was in Q3, though.
The US Federal Reserve hikes rates for the second time this year, signals that not one but two more in 2018.
All right, let's take a look at the markets first. Neeraj is here with us. Afternoon, Neeraj.
Hey, afternoon, guys. Slightly weak and led not necessarily by banks, though ICICI Bank and SBI are down. But technology is pulled back today on 25 years of Infi lists being listed. TCS, Infi, Tech Mahindra, amongst others, all of these have come off. So it's not just banks, but technology which has come off. And select oil and gas names too are putting pressure. So the likes of ONGC, for example, is down and out. But tech, the biggest culprit today, with both Infosys, TCS, and then a host of others like Tech Mahindra too, looking slightly wobbly in trade. Select names based on news or otherwise have corrected. So the likes of ICICI Prudential or Oberoi Realty, which has started a QIP, and that set of names have had some corrections in the session today, but that's very, very stock specific. The volumes in today's session a bit higher than average, but that's to be expected because it's the Bank Nifty weekly options expiry. So you have the NSE FNO volumes being substantially higher, but the cash market volumes, guys, the last 2 or 3 sessions have been subpar almost every single day. In today's session to just 14,000 crores done right now, or 15,000 crores. Doubt will really eclipse that 28,000, 29,000 or a 30,000 crore mark. So the cash market volumes the last few days, very, very muted. Volatility hasn't jumped up too much today despite there being this expiry. Let's wait and watch what happens over the course of the next half an hour. But watch out for the Nifty Bank. That's the one to monitor today, simply because the next 1.5 or 2 hours will have enough and more options trade being done on the Nifty Bank for it to be volatile.
Yes, thank you for that. That's the markets for you. The US Federal Reserve raised interest rates for the second time this year, just as expected. What changed, though, is the stance taken by the Federal Open Market Committee, or the FOMC. It hinted at a hawkish approach towards monetary policy and penciled in a fourth rate hike this year. Kathleen Hayes of Bloomberg News tells us what this means for rates in the economy in the long run.
The 25 basis point rate hike is expected. No big deal. But it was a very small shift in the dots that hit the bond market, hit the stock market, is hitting Asian markets as well. People, I think, are still trying to figure it out. Dots go, DOTS on the terminal, tells you this story in pictures. You have 7 dots saying, I think we're probably going to need to hike rates 4 times this year. Those dots represent FOMC members. Now there's 5 that say, no, I think 3 is more like it. That had been evenly divided, 6 versus 6. Now, it's interesting. We had Roberto Perli on Bloomberg Television just a couple of hours ago. He was the Division of Monetary Affairs at the Fed's Board of Governors. Very important position, a lot to do with setting policy. Here's what he said about the shift in the dots.
It's not a solid signal. I would be inclined to think about it in terms of more noise than signal. I think what the Powell Fed will do is we'll look at the data and take his clues from there. But I think the dots are a little bit just an exercise in forecasting.
Now, it's true markets also saw some hawkishness in the change in the FOMC's outlook for the economy. A little bit stronger GDP, lower unemployment, inflation a little bit stronger. But I think people maybe should pay strong attention to what Jay Powell said at the press conference. He sees wide uncertainty bands around things like the natural rate of unemployment. Where's the neutral rate? The rate maybe would signal the Fed should stop or only go a little bit further. And he said the Fed policy will be guided by incoming data. We will try to keep our minds open. So maybe we're seeing a little more hawkishness, at least in the Fed chair, than is actually there.
All right. Neeraj spoke earlier to Adrian Mowat and Jeffrey Dennis of UBS to try and understand what the implications for the markets are. Listen in.
It was the tone of the Fed in terms of their confidence that the rates would continue to rise and their optimistic statements around the economy that might have taken markets by surprise. I think there's also a dynamic here where, market confidence is relatively low. When you look across the performance of markets year to date, the US market's up a bit, China's up, but many other markets are weaker. Even the sectors that should be beneficiaries of higher rates, like banks, don't seem to be performing particularly well at the moment. So I think the markets perhaps are telling you a little bit more about their weakness rather than really indicating a change of view with regards to the Fed.
Jeffrey Dennis, it's not just about the 2 hikes now, the mean rates that everybody expects in FY19 also, all of that signal towards, if not faster, then more rate hikes than what the market would have presumed. Is it essentially due to growth or due to also a belief that inflation is right around the corner? And therefore, what does it do to yields in the near term in the US?
I don't think it's because inflation is assumed to be right around the corner. I think what the Fed is doing is ensuring that they've got some insurance out there, if you like, in case inflation does pick up more than anticipated. But I think the key point is Adrian's got it absolutely right. I think the market was sort of hovering between 3 and 4 rate hikes this year. We at UBS had 4 rate hikes in our forecast. And frankly, we think the market has overreacted to this because at the end of the day, we haven't changed our interest rate forecast on the back of this. And I think, as I say, I think all the Fed is really doing is just telling the world that they are comfortable about what the economy is doing. The economy's clearly picked up, and they just want to be signaling clearly to the market that in the event that inflation does surprise to the upside, they would be willing to do more. But at the end of the day, as I say, our forecast is still that rates will have no different a peak than we thought they would have this morning. And so we fully expect this little bit of bearish sentiment here that's come out of this meeting to subside probably relatively quickly. Interesting.
Adrian, one thing that you got to give credit for to the Fed now, they're wanting to be a lot more open about what their thought process is. And maybe that's why this move to having a Q&A after each of the policy statements as well. Now, my question to you is, if indeed the Fed is preparing the markets well for what it would do, and if indeed the economic factors are the big reason behind the rate hikes as well, a rising U.S. economy, falling employment, etc., would all probably augur well for the equity markets. And if indeed the US markets are slated to do well, if they do, they will not do that in isolation, right? Emerging markets, by and large, would also follow suit.
Well, no, I think the story of 2018 is that emerging markets are not performing in line. There's a big divergence of performance across the emerging world. So some of the simple commodity-related markets, the Perus, the Colombias are doing very well. You've got okay performance out of China, although much of that happened in the month of January. And then if you go to the other extreme, you've got markets such as Indonesia, Turkey, the Philippines down double digits, and a market such as Turkey, particularly vulnerable to rising funding costs. And as the Fed moves rates higher, you see that funding costs are not just moving up in US dollars, they're moving up in other currencies. So, yes, I accept your point that a good US economy is broadly good for global capital markets. But then when you look at the specifics that you invest in, we've got a story where the tech-heavy markets of North Asia are doing okay. I think for China, there's an interesting divergence in forces at work there. You know, the Chinese economy looks okay, earnings look okay. But if you look as US rates are moving higher, we're seeing monetary conditions in Hong Kong tighten, with HIBOR at a 10-year high. And that having a little bit of pressure on the Hong Kong Stock Exchange, where many of the Chinese companies are listed. So, yes, generally when the US is doing well, that's good for global markets. But remember that the forces at work here are having a diverging effect across the emerging.
All right, that move from the Fed and the change, perhaps in the indication of how many rate hikes will follow, hasn't impacted the domestic bond markets. The 10-year yield continues to trade around the 7.95 mark. If anything, they'll be taking note of the WPI numbers that came in today. WPI at a 14-month high, showing pressure building up on all counts. And yes, there is pressure from the fuel and light index. That is to be expected. There is also pressure from the other commodity segment, which is to be expected. I think what was important to note was the manufactured product segment, and if you run through the sub-segments within the manufactured good inflation, which is demand-driven inflation, you'll see that every category within manufactured products seems to have shown an increase. Not to say it's a very large, dramatic increase, but just to say that input cost pressures are building up, as are now output cost pressures.
Interesting. Now, the other macro data that came in, of course, was the current account deficit number that widened in the fourth quarter of fiscal 18 on account of higher trade gap. The current account deficit stood at $13 billion, or 1.9% of GDP. That's according to data released by the Reserve Bank of India. This is significantly higher than the 0.4% of GDP seen in the same period last year, but marginally lower than the 2.1% that we saw in the December quarter. Joining us now on the show to discuss a little more about this and other macros, Madan Sabnavis, Chief Economist at Care Ratings. Madan, pleasure to have you as always. What did you make of the CAD number? And there are many who are comparing this to the 2013 situation. Would you make that too?
So, ultimately, looking at the CAD, I think we should be looking at it on an annual basis, because what we look at it quarter to quarter is what actually builds up to the entire year. And what we are really looking at is a target for the entire year where we are saying that we are around 1.9%, which I think is a fairly comfortable number as far as any country's balance of payments go. But I think the interesting factor is that we have seen a fair amount of stability in terms of software receipts, which we thought probably would decline after the kind of stance which the US government was expected to take. We are seeing some kind of stability even in terms of the remittances. So which means that the sore point is going to continue to remain the trade deficit. And everything is going to be driven by the oil price, because we have seen that as the oil price goes up, our imports go up, and we don't see a commensurate increase in exports. So the trade deficit is going to widen, and therefore the CAD is going to widen. So going ahead for this particular year, I think there's going to be continued pressure on the trade balance and hence the CAD. And what is going to be important is how we are managing to balance that through our capital accounts. So I think your foreign direct investment, foreign portfolio investment, ECBs, NRI deposits, I think all these are going to play a very important role in the coming year.
Madan, afternoon, Neera joining in as well. Madan, I know that oil is, sort of the dominant headline factor, but I think increasingly people are starting to point out that even if you strip out oil, the core balance is also not entirely positive. Now, I don't know whether that was a factor, a FY18 trigger because of all the disruptions, or if that's something that continues into FY19 as well.
So, see, the other factors, what we have seen is that we should remember that last year the rupee remained fairly, I would say, strong relative to the dollar. And the kind of a competitive advantage which we could have had at a margin for certain commodities was probably missing. So I think that's something which might have also affected the growth in our exports, which sort of widened it. And the other thing we should remember also is that our exports are also dependent a lot on what happens to global growth. So if I need to have a vibrant global economy to push forward my exports. So oil is going to be one factor on the import side, but if you look at the exports, I think that's also was handicapped last year. Now with the rupee depreciating, there could be some kind of regaining of opportunities as such which we have in the international market. But we should also remember that other currencies, competing currencies, are also going to keep depreciating and getting weaker. So we need to see what's going to be the final result. But I think the other import components, things like gold, coal, I think these are the two other elements which have been disrupting our trade deficit in the past. They also need to be monitored. But I don't see too many pressures coming on gold or coal in the coming year. It's going to be more driven by the oil price.
The other data point, Madan, of course, is inflation. Wholesale prices are at 14-month highs. Consumer prices are also inching upwards. What's your reading of what the trend line of inflation is likely to be?
So in terms of WPI inflation, I think this number of 4.3% which we had would probably be on the higher side, because we should remember that we are talking of the month of May. That's the time when the crude oil price also went towards past the 18 mark. But since then, there has been a bit of a retreat which has taken place, which means that while the WPI number will definitely remain in the 4% region, it's not going to keep increasing unless the OPEC decides not to do anything when they meet next week. So once again, I think the important part is going to be what happens from the oil front, because if you look at the WPI, it's more vulnerable to the oil price than the CPI. And given the fact that commodities like, say, petrol or diesel are still being linked to the market and there's no element of subsidy, and the transmission so far has been almost seamless to the consumer, it's going to continue to exert pressure on the WPI index.
Madan, sorry, I'm going back to the BOP data, although in some ways also links into what's happening on rates here. Just in terms of, what BOP in FY19 could look like, are you penciling in the possibility of BOP turning negative if, the experience of capital flows in the early part of this year is anything to be going by?
Not exactly negative, but I think the kind of an increment which we had last year, I think it was something in the region of around $40 billion, if I remember right, may definitely not be there. Maybe a more modest $10 or $15 billion. Because I think there's going to be a greater reliance which is going to be on the foreign direct investment. And as you mentioned, FPI is going to continue to be close to zero or maybe negative. It'll just be this way or that way. But it's going to be a lot depending upon what happens to FPI. And I think today we're in a situation with the interest rates going up in the international markets. ECBs may no longer be as attractive as they were in the past. And I think there's some talk, I think one of the investment banks can bring out about getting in the NRI deposits, some more of these kind of deposits like what we had in 2014. That's something probably which could also be contemplated by the government. So on the whole, we're still looking in terms of a marginally positive accretion to foreign exchange reserves in the year. Nothing in the region of around $40 billion, maybe 10 to 15 on the upper side.
One final question from my end, Madan. This is with respect to the rupee. Given this macro picture that you've spoken about, where do you see the currency going? Because, this was a matter of debate a couple of months ago. Directionally, is the rupee headed, is it going to get stronger or weaker?
I think it's quite clearly going to become weaker. Now, giving an exact number will always be difficult in these volatile conditions. And currently, we're looking at a rate of 67.5 to 68, at least for the next 2 or 3 months. Because we should remember that the Reserve Bank of India would also be intervening sporadically in the market to ensure that there is not too hasty a kind of a depreciation which takes place. But the direction is definitely going to be a weaker rupee for the rest of the year.
All right, Madan, thanks so much for that. Appreciate you giving us your views on a host of economic factors. CAD, of course, came in yesterday. WPI came in today. Let's move on. A vacancy at the Statistics Department has put India's economic data reputation at risk. 4 months after TC Anand retired as the chief statistician, the government is still hunting for a replacement. Prishti Beniwal has this report.
India is looking for a chief statistician for almost 5 months now, but no luck yet. Former head of Stats Office TC Anand retired on January 31st, and the government posted a vacancy almost a month after he retired, somewhere around February 23rd. But since they have been looking for someone, and there is no announcement on when the new chief statistician will be appointed. All this is happening at a time when data is very crucial in India. The Stats Office is planning to come up with new data series. They are planning to revise pace year for macroeconomic data, a new time use survey they are working on, and they will come up with a periodic labor survey, labor force survey also. So all this is clearly putting the reputation of Stats Office at risk at this crucial point. What is leading to the delay is a change in the process, the selection process. Earlier, the Deputy Chairman of Planning Commission would select the head of MOSPI with help of experts. Now, the government has given this job to the Cabinet Secretary. Cabinet Secretary will select a person, he will forward some names to the Prime Minister, and then the Prime Minister office will take a call on who gets to be India's next chief statistician.
Rishi, thank you so much for that. Rising interest rates and volatile bond markets have prompted Indian corporates to make debt offerings to the public. It's already 8 times the total issuances made in the last financial year. Anurag Joshi of Bloomberg News is here with more details. Why is it, why are Indian corporates, offering debt to individuals now?
Well, in the current context, you had the RBI policy and you had a rate hike. There's more rate volatility in the market. So there is there's an element of resistance from the wholesale investors to corporate bonds. So companies are looking at the public as a good avenue to sell bonds where, of course, they have to offer a higher rate. But in terms of, the issuance, in terms of, the fundraising, it is going on well. So you had 2 issuance very recently, like you had Diwan Housing and you've had JM Financial Credit, and both of them did very well in terms of the fundraising. And in fact, even if you look at the relative value, you look at the Diwan's bond issue is on for a 3-year bond. It's offering an yield of 8.9, which is more than what SBI's deposits offer. So, of course, investors can hope to get a high yield from these investments. So, and that's the reason why companies are looking at public issues.
All right, thank you so much for that.
It's been 25 years today since India's homegrown software services firm Infosys listed on the bourses. Established by 7 engineers, Infosys was then just beginning to make a mark in the global technology landscape. 25 years later, it is the second largest IT company in India by market cap and one of the most watched and traded stocks in the country. Agam Vakil is putting together Infosys' journey since listing. Agam.
Well, good afternoon, and I'd suggest that back in the 90s, I'm sure there were very few conversations with respect to the Indian equity markets, and there wouldn't be a mention of Infosys because the staggering returns that the behemoth has given a lot of its investors. That said, I thought that I'd break the journey of Infosys through the leaders that it's been with, and right at the top, of course, we're going to have NRN, who's possibly and arguably the most successful leader for Infosys, based on at least on the few parameters that I'm tracking right now. Let's start off with the market capitalization. From around 280 crores of market cap when Infosys listed on the 14th of June back in 1993, it moved up to the market cap of as much as 25,000 crores. And along the way, somewhere along the way, we also saw Infosys hit the market cap of as much as 50,000 crores. Under Narayan Murthy, when it comes to revenues, to staggering growth coming through. In fact, 73% CAGR in that 7-year term coming on from 55 crores back in March 1995 to as much as 2,600 crores. And also operating margins were at its highest at around 29%. And it wasn't very different for Nandan Nilekani either, who was the next CEO at the helm. That's where you saw the market cap again grow another 4.5 times from around the mark around 25,000 crores to as much as well over 1 lakh crores. Of course, the next milestone in the market cap also at around 1 lakh crores. Coming through under Nandan Nilekani. Again, a very successful term when it comes to growth in terms of revenues, 40% CAGR, and we saw revenues move for the first time above the mark of 10,000 crores under his leadership. After Nandan Nilekani was when we started seeing some subdued moves coming through, though of course under Chris Gopalakrishnan we did see Infosys again move up to the market cap around 1,50,000, but when it comes to revenues, more subdued 19% CAGR under his term. And again, we did see a little bit of a fall when it comes to operating margins, still at around a healthy 27%. Now this is where it gets interesting. Around then, if we can actually pull up the market capitalization of TCS as well as Infosys around the same level. As you can see, back then when TCS listed, TCS and Infosys moved largely in tandem. It was only in early 2008 that TCS's market cap went well below and prominently below that of Infosys. And since the early of 2010, TCS has, convincingly moved much higher than Infosys, and then since hasn't looked back. There are a few reasons behind it. Of course, TCS's staggering growth after 2010 and beating that of Infosys. Of course, Infosys was also going through some internal challenges, but this tells you a story about how there has been a divergence in trend in growth for Infosys as well as TCS, not only in terms of the market cap, but also in terms of revenues. That said, coming down to your revenues growth in terms of so you have Shibulal, and that's where you see once again your market cap move up to around 2 lakh crores for Infosys. This is when we genuinely saw some subdued and slackness coming in growth. So when it comes to the CAGR in terms of revenues under Shibulal for Infosys, which stands at roughly around 13%, and you should have that plate again. Okay, there you have it, 11%. TCS in comparison, their CAGR in the same period was 30%. So that's where you see that divergence between Infosys and TCS, with internal struggles in Infosys as well. And after Shibulal, of course, we had Vishal Sikka, where once again, Infi did hit that next market capitalization milestone, but in terms of growth, your CAGR came down to below double digits at around 7%, even as TCS in comparison showed us a 13% CAGR in the same period. And this was the first time around when the operating margins for Infosys fell below the mark of around 25%, and it's been struggling ever since. Well, Salil Parekh has well, a lot to do, a lot of responsibility to carry out the transformation in Infosys. Of course, while we did see revenues, well, with subdued growth of around as much as 70,000 crores in FY18, he is projecting about a 6 to 8% growth. Well, of course, this is in single digits, much lower than a lot of their Infosys peers as well, and margins guided at 22 to 24%, perhaps the lowest that Infosys has seen. A lot of responsibility on the shoulders of Salil Parekh, and we're going to have to wait and watch whether or not Infosys actually manages to take part in the next leg in the technology revolution through digital services.
Agam, thank you for putting that in perspective. That's the story of Infosys over the last 25 years. Meanwhile, fund houses have finally rejigged their schemes to conform to SEBI's new categorization norms. But will the new structure gel well and with their overall portfolios, and how will it impact your tax outgo? Neeraj sat down with mutual fund experts Kunal Bajaj and Tarun Birani. Listen in.
The tax bit is just a reality that if your fund is changing category dramatically and doesn't fulfill the role it was playing in your portfolio, then the right thing to do is to sell it and take the hit, the tax hit. That's just the harsh truth and the only way to go about it.
Yeah, in terms of exit loads, I think if you do it under that period, your exit loads will not be charged.
Can you explain that? Sorry.
So there are two kind of cost which an investor can incur, right? Exit load if you are going before that time horizon, and second would be the tax cost.
What is the time horizon?
So time horizon differs from category to category. Equity as a category more than 1 year is something erstwhile used to be a long-term capital gain. Today we talk about 10%, yeah. And debt as a strategy, 3 year plus is something what is recommended. So anywhere, I don't see much of the disruption, at least on the debt shorter end. On a longer end, there are a lot of stuff, but I think their investor can continue where they are and let them complete that 3 year horizon. On the equity front also, I don't see any meaningful disruption for investor bearing some 3 to 4 schemes where investor can take an informed call and move ahead.
Moving on to global news, Japanese flea market app Mercari will give one of its existing investors, United Inc., a return of 149 times when it lists later this month. United had invested $2.7 million in 2013, and this IPO is also being looked upon as a turning point in Japan, where startups are not as popular or successful as in other Asian countries. Mercari's founder is one of the most successful startup entrepreneurs in Japan, and shot to fame when he sold his first company, which had already been doing extremely well.
Well, it comes once in 4 years. It's had more than 3 billion viewers tuning in last time around, and this time it's in Russia. The FIFA World Cup 2018 kicks off in Moscow today. 32 teams are competing for the coveted title, and national pride's at stake as well. But here's a factoid. The prominent footballers earn a whole lot more from club football than playing for their nation. So who are the top 5 most valuable footballers playing this year? Yash has those details.
So we'll start off with the 5th most valuable player, and at number 5 is Belgium's playmaker Kevin De Bruyne. He's had a fantastic season with Manchester City, where he has won the Premier League title and assisted 16 times. And now with the likes of Eden Hazard, Romelu Lukaku and Dries Mertens up front, surely we could expect Belgium to score a whole lot of goals in this time's campaign. At 4th place and tied in terms of value is Harry Kane. He is estimated to be worth about $181 million. Boasting of a young and a talented England side, Gareth Southgate's England are definitely one of the dark horses to win this year's campaign. The England striker has been in prolific form, scoring 30 goals for Tottenham Hotspurs in their successful campaign, which saw them finish 4th in the league. Now with that and 13 goals in 24 caps for the Three Lions, Harry Kane is surely one of the most lethal attackers in the tournament and one to watch out for. But let's move on, and at number 3 we have the Egyptian Messi, Mohamed Salah. He too is estimated to be about $181 million. He's had a breakout campaign with Liverpool following a €40 million move from AS Roma, where he managed to score the most number of goals in a Premier League season than any other player. Now with that, he has single-handedly taken Egypt to their first ever World Cup since 1990. Having suffered a shoulder injury in the Champions League final last month, surely the Egyptian fans would be missing him out in the first 2 matches of the group stages. But on to the number 2 spot and the joint most valuable player, that is Lionel Messi. He is worth about $217 million. Now, he's had a dominating season with Barcelona, scoring 50 goals in all competition. Now, with 9 Spanish titles and 4 Champions League winners' medal, Lionel Messi is undoubtedly one of the greatest of all times, if not the best. But it is the form and the success at the national level that has eluded the 5-time Ballon d'Or winner. And for Argentina, it would be very important for him to replicate that form at the national level as well. And finally, we're looking at Brazil's Neymar. He too is estimated to be about $217 million. Now, he's had a successful first campaign with PSG, following a world record €222 million move from Barcelona. He scored 19 and assisted 13 times in the league with PSG, winning the title with 5 matches in hand. For Brazil, it would be his form and most importantly his fitness for them to go as far as they could in this year's campaign. But a small disclaimer, these are the values that transfer market has assigned to these players. They have a whole host of criteria such as the age, the performance of the player and the number of years pending on their contract. So if any of your favorite player does not feature on the list, well, that is the reason for it.
Okay, so talk us through some of those guys whose market value is high, but they've not made it to the national teams this time.
Some of the top quality players, they have not made it to Russia. So at number 5 is France and PSG superstar Adrien Rabiot. He's a young 24-year-old player. He's worth about $60 million, and a string of poor performances in the national colour and a dip in form towards the second half of the season saw the Frenchman not being selected for the season. Alvaro Morata, he's had a disappointing first campaign for Chelsea following a big money move from Real Madrid. A dip in form and a slew of injuries saw the Spaniard being sidelined. He managed to score only 11 times in this season and eventually lost out on his first team spot to Olivier Giroud. Now, keeping up with the French team in number 3 is Anthony Martial, the $78 million French attacker. Now, he's had a disappointing campaign with Manchester United after falling out of favor with manager Jose Mourinho and losing out on crucial game time following the signing of Alexis Sanchez from Arsenal. Because of this reason, he was dropped, but he would be a key player who would not be playing there. But the most important and the most crucial omission in this list has to be that of Manchester City's Leroy Sané. The young player of the year took the Manchester City team to their first Premier League title in 4 seasons and assisted 15 times, just one less than Kevin De Bruyne with 16. And now it would surely be a big shocker to not have such a young and talented player to be missing out on his flight to Russia. But it is Mauro Icardi who's the most valuable player who won't be making it to Russia. This is because of an immense pool of attackers that Argentina already has. They have the likes of Messi, Aguero and the Juventus duo of Higuain and Paulo Dybala. So probably his services won't be missed.
Yes, thank you so much for that. The action starts this evening.
All right, that's a wrap on this edition of Power Lunch. Coming up next is a conversation with Vallabh Bansali of the Enam Group on Infosys' journey in the equity markets.